The 2008 financial crisis explained how Wall Street crashed the economy, how Wall Street destroyed the economy and got away with it. 2008 crisis. The 2008 housing crash, $19 trillion lost, zero bankers jailed, Lehman Brothers collapse. How one bank triggered the Great Recession. September 2008. A 158-year-old bank collapsed overnight. $600 billion evaporated. Retirement accounts vanished. Millions lost their jobs. But what if I told you the real cause started with a lie so simple you could fit it on a billboard? Why rent when you can own? That single question triggered the worst financial crisis since the Great Depression. And the terrifying part, the people who caused it got rich, got bailed out, and never went to jail. Welcome to 2008, where the American dream became the American nightmare. Cue the upbeat music. It's 2002. America is still nursing a massive hangover from the dot-com bubble crash. September 11th just sucker-punched the entire economy. And Wall Street is understandably kind of twitchy. But don't worry, the Federal Reserve has a brilliant plan. Slash interest rates to basically zero. Boom. Money becomes incredibly cheap. Borrowing is ridiculously easy. And suddenly, everyone's favorite national pastime isn't baseball anymore. It's buying a house you absolutely cannot afford. Congratulations, you're approved for $500,000, but we only make $40,000 a year combined. Not a problem at all. Adjustable rate mortgage, balloon payment, ninja loan. Wait, what's a ninja loan? No income, no job, no assets, no problem whatsoever. See, back in the early 2000s, homeownership wasn't just about having a roof and four walls. It was the American dream incarnate. It meant stability, social, status, suburban bliss with a white picket fence. And the message being aggressively pumped through every advertisement, billboard, and mortgage seminar was loud and crystal clear. Why rent when you can own? Banks agreed enthusiastically. In fact, they agreed so hard they started throwing money at people like it was a television game show and everyone was automatically winning. Enter the subprime mortgage. Translation: loans specifically designed for people with terrible credit, completely unstable income, or only a vague idea of what money even is. Bad credit. No credit. Literally living in a van down by the river. You, sir, qualify for a luxury waterfront condo. Should I be worried about paying this back? Not your problem. If you default on the loan, we'll just sell the house for even more money. Housing prices only go up. Remember, it was a housing gold rush, an absolute frenzy. Everyone was buying property. Prices skyrocketed irrationally. Your neighbor's house doubled in value in just 6 months. Totally normal. Even McDonald's part-time workers and Starbucks baristas with $5 in their savings accounts were getting approved for 6-figure mortgages. Just a completely normal day in the 2000s. And the lending rules. Oh, those got loans straight out the window! Traditional lending standards were too slow and boring. Risk assessments were too complicated. Down payments became completely optional. If you had a detectable pulse and could sign your name, you qualified for a mortgage. People bought houses like they were buying ramen noodles at the grocery store. Lenders printed loan documents like they were printing Monopoly money. Mortgage brokers made commissions faster than they could say the word bubble. Behind all the buzz and excitement was a blind faith that housing prices would always go up indefinitely because, historically, they always had. Until now, but beneath the open houses and granite countertops, one question quietly lingered. What could possibly go wrong? Spoiler alert, everything. But we're just getting started with this disaster story. By 2005, buying a house wasn't about stability, family, or building wealth anymore. It was about flipping it like a pancake and desperately hoping the next buyer paid double what you did. Real estate wasn't shelter. It was a lottery ticket. I teach phonics to kindergartners during the day and buy condos at night for fun. I just bought my 3rd investment property with 0 down payment. I don't even live in any of them. Here's your latte. Sorry, it took an extra minute. My bank just called and offered me another penthouse in Miami. This wasn't responsible investing. It was a national obsession bordering on mass hysteria. Buy, flip, profit, repeat, endlessly. And the more people joined in, The higher prices soared. The higher they soared, the more desperate people rushed in. It was like trying to put out a raging fire by throwing gasoline directly at it. And everyone had a match ready. But beneath the red-hot exterior was structural rot. Those subprime mortgages, everyone was gorging on like candy. They were catastrophically bad. Like genuinely terrible. High risk, low documentation, barely verified debt given to people who couldn't afford groceries. But Wall Street had a magic trick up their expensive sleeves. They bundled all that toxic junk together, slapped an official-looking label on it, and sold it to institutional investors as perfectly safe, introducing mortgage-backed securities. Now with 80% more lies and fraud. How do you make toxic loans look like solid gold investments? Easy. You get the credit ratings agencies to officially call them A. This bundle's got bankrupt baristas, unemployed gym brothers, and people who think assets are what you sit on. Seems perfectly fine to us. Here's your A rating. Here's the part they conveniently don't put on the glossy brochure. The ratings agencies were literally getting paid by the exact same banks they were supposed to be objectively rating. It's like hiring a food critic to review your restaurant, then telling them they won't get paid unless they call your raw chicken Michelin-starred quality. Behind closed doors, the ratings agency analysts knew this bundle was a sack of flaming garbage. But the checks cleared, so they smiled and stamped it. But Wall Street wasn't done cooking up financial disasters yet. They took those shaky mortgage bundles and blended them into something even more unnecessarily complicated. Collateralized debt obligations, through financial alchemy that would make medieval wizards jealous, garbage loans magically became investment-grade assets. It was like turning lead into gold, except the gold was actually radioactive and would eventually explode. Actually, not everyone was completely fooled. A handful of investors, oddballs, skeptics, troublemakers, who actually read the fine print. They saw the structural rot festering inside the boom, and instead of blindly buying in, they asked one bold question. What if we bet against this entire house of cards? Problem. There was literally no financial product that lets you do that. So they marched confidently into Wall Street's marble fortresses and said, "These loans are complete garbage. We want to short them. Can you build something that pays us when they inevitably go bust? You want to bet against the housing market? That's adorable and incredibly stupid. Fine. You want insurance? We'll write it happily. You pay us monthly premiums, and when nothing happens because housing never crashes, we pocket the premium forever. Ebberjohn wins. Especially was. I mean, it's not like the whole system's going to collapse catastrophically, right?" Wall Street smelled easy money. They didn't believe these crazy investors for a second, but they absolutely loved the idea of collecting steady premium fees on something they thought could never possibly fail. So they got to work and cooked up the financial instrument that would eventually blow up the entire world economy. Credit default swaps, insurance contracts that paid out massive amounts if those mortgage-backed investments went bad. The weird thing is, you didn't actually have to own the underlying investment to buy the insurance. It was like buying life insurance on your neighbor's grandmother, and then actively rooting for her to slip on the stairs tomorrow. The whole system was a massive Jenga tower made of lies, leverage, and greed. Every single block was a bad mortgage. Every layer represented a bigger, riskier bet. And at the very top, bankers raising champagne glasses. Cheers to another record bonus quarter. Who needs ethics or risk management when easy money is flowing like wine? Whistleblowers were systematically ignored. Regulators were literally dozing off at their desks. And the people in charge, too rich to care, too greedy to stop. The party raged on while the floor quietly cracked beneath everyone's feet. At first, it was barely a whisper. A missed mortgage payment here, a foreclosure notice there, a luxury condo in Las Vegas sitting empty. But then came the wave, and suddenly the unthinkable became the front-page headline. Home prices are falling, but housing always goes up. It's basic economics. That's not supposed to happen. For years, the housing market had been a Jenga tower made of lies, leverage, and wild optimism. But in 2007, someone pulled the wrong block, and everything started wobbling. The subprime loans, those risky, rotten deals, wrapped in financial tinsel and AAA ratings, started to implode spectacularly. And the mortgage-backed securities built on top of them. Yeah, they were ticking time bombs, and they all exploded simultaneously. Banks that had proudly stuffed their investment portfolios with supposedly safe AAA-rated assets suddenly realized with horror they were holding radioactive financial garbage. Those AAA-rated bundles. Actually, financial plutonium. We can't sell this toxic junk. The market bid is zero, but that means we're holding worthless paper. Yeah, we're completely screwed. Panic spread through Wall Street like wildfire. Hedge funds bleeding billions. Investment banks slashing massive losses. And then, boom. Lehman Brothers, a 158-year-old institution, gone overnight. No government bailout, no white knight hero, just a $600 billion crater blown in the middle of Wall Street. The message to every other bank was crystal clear. If Lehman can die, absolutely anyone can. Overnight, banks stopped lending to each other entirely. Credit markets froze solid like ice. It was like someone violently yanked the power cord on the global economy. I desperately need a business loan to make payroll this week. Sorry, no liquidity available. What does that even mean? It means we're closed indefinitely. Good luck surviving. Everything jammed simultaneously. Families couldn't get mortgages for homes. Businesses couldn't make payroll for employees. Investors couldn't cash out their positions. Retirees watched their pension funds evaporate in real time on their computer screens. 401k retirement accounts toast. Life savings gone. Job market completely vaporized. By late 2008, it was full economic collapse mode. Millions suddenly unemployed. Foreclosures through the roof. Eviction notices stacked like junk mail. Soup kitchens couldn't keep up with demand. Unemployment offices looked like disaster relief camps after a hurricane. This wasn't just Wall Street burning anymore. This was Main Street in absolute freefall. And the crisis didn't stop politely at the U.S. border. Iceland's major banks collapsed. Tokyo stock markets plummeted. European leaders scrambled desperately to respond. From London to Reykjavik, Tokyo to São Paulo markets crashed violently. Banks buckled. Global economies spiraled downward. The question was no longer who's next to fail. It was, is the entire global financial system fundamentally broken? The Great Recession had officially begun, and nobody knew where the bottom was. The U.S. government faced one impossible choice: let the entire system burn to the ground or throw billions of taxpayer dollars at the very same guys who lit the match in the first place. October 2008, they picked the latter option. I need $700 billion. For what exactly? To shovel into burning banks before the whole thing explodes and takes down civilization. Enter TARP, the Troubled Asset Relief Program. Basically, the government was giving Wall Street a $700 billion pillow to fall on. Why? Because these banks weren't too big to fail. They were too interconnected to fail. Let them collapse, and they'd take down the entire global economy like doom. So the government did what it had to do. They started throwing money out of helicopters. Seriously. Loans, bailouts, stock purchases. It didn't matter what form it took. If your balance sheet had smoke coming out of it, Uncle Sam brought the fire hose filled with taxpayer money. But it wasn't just banks getting the golden parachute treatment. AIG, the insurance giant that had bet trillions on garbage investments, got over $180 billion in emergency aid. Even General Motors and Chrysler, car manufacturing companies, got $80 billion. It was financial triage on a scale no one had seen since the Great Depression. Meanwhile, over at the Federal Reserve, Chairman Ben Bernanke was busy rewriting the traditional rules of economics with a money cannon. Interest rates sliced too near zero. Borrowing became basically free. And then came the big controversial one. Quantitative easing, which is just fancy economic speak for the Fed started printing money out of thin air to buy bonds and mortgage-backed junk. Think of it as patching the Titanic with $100 bills. Don't worry about inflation. Just let me cook. And guess what? It kind of worked, at least on paper. Markets slowly calmed down. Banks gradually unclenched. The stock market bottomed out in March 2009 and started crawling back up. Wall Street collectively exhaled with relief. But Main Street, still choking on smoke and unemployment. The aftermath was absolutely brutal for regular Americans. Unemployment hit 10%. 8 million jobs permanently gone. 4 million homes foreclosed and families evicted. $19 trillion in household wealth vanished into thin air. Families that had never missed a single payment suddenly owed more on their homes than the homes were actually worth. They were underwater. And people were furious. Wall Street executive bonuses are back already. I just got evicted from my home, and they get million-dollar bonuses. The people who directly caused the collapse got bailed out with taxpayer money. The people who lived through the consequences got pink slips and food stamps. Wall Street popped champagne bottles and celebrated survival. Main Street stood in line for soup kitchens, and then came the rage that would define a generation. 2011, Zuccotti Park, New York City. Thousands gather with tents, drums, and cardboard signs. One reads simply, "We are the 99%. The Occupy Wall Street movement wasn't just about bailouts anymore. It was about a system that appeared fundamentally rigged to protect the powerful, privatize profits when things go well, socialize losses when things go bad, and a total absence of criminal justice. No major Wall Street CEO went to jail. Not one. No handcuffs, no perp walks, no prison sentences. Just golden parachutes worth millions and quiet, comfortable retirements. The system survived. Barely, but public trust burned completely to the ground. An entire generation grew up knowing one simple truth. When the banks mess up catastrophically, they get rescued by the government. When you mess up, even slightly, you get completely wrecked. The game was rigged, and everyone could finally see it clearly. In the end, 2008 taught us that the financial system isn't built on solid ground. It's built on trust. And when that trust evaporates, everything collapses. We learned that greed without consequences creates monsters, that complexity can hide fraud, that ratings agencies can be bought, that regulators can be captured, and that when the house of cards finally falls, it's never the architects who pay the price. It's everyone else. Because if 2008 taught us anything definitive, it's that the next crisis doesn't look like the last one. It looks harmless, profitable, and inevitable, until suddenly it isn't. The 2008 financial crisis destroyed millions of lives while the people responsible walked free. Hit subscribe if you want more stories about the moments that changed history. Comment below. Could it happen again? Are we headed for another crash? Thanks for watching.